Why does it feel like the system smiles at borrowers while savers quietly fall behind? At first glance, borrowing looks risky. Debt feels heavy. Interest sounds dangerous. From childhood, many of us are taught that owing money is a mistake, something to escape as fast as possible. And yet, when you look closely at how the modern world actually works, a strange pattern begins to appear. Those who borrow, when they understand the rules, often move faster, grow larger, and gain access to opportunities that remain invisible to everyone else. This is not an accident. It is not a glitch. It is how the system was designed to function. This story is not encouraging reckless behavior. It is about understanding incentives, structures, and quiet truths that shape daily life. Once you see them, it becomes impossible to unsee them. Imagine two people starting from the same place. Both work hard, both save carefully. One avoids debt completely, believing safety comes from staying clear of obligations. The other uses borrowing strategically, not blindly, but intentionally. Over time, their paths begin to diverge. Not overnight, not dramatically, but slowly, quietly, almost invisibly. Years later, the gap feels shocking. So what happened? The answer lies in how money flows, how institutions think, and what the system quietly rewards. At its core, modern economies are built on movement. Money sitting still helps no one in power. It does not fuel growth, it does not create expansion, and it does not justify new structures. Borrowing, on the other hand, creates motion. When money is borrowed, it moves through banks, markets, businesses, and labor. Each step generates activity, and activity is the heartbeat of the system. This is why borrowers are often treated not as risks, but as participants. When someone takes on a loan, they are signaling something powerful. They are declaring confidence in the future. They are saying tomorrow is larger than today. Systems built around growth respond positively to that signal. They reward it with access, flexibility, and sometimes forgiveness. Savers, by contrast, are cautious. They delay consumption. They wait. While this feels responsible, it does not always align with how large systems measure value. From the system's point of view, delayed action slows momentum. This is where things begin to feel unfair. Borrowers often gain access to assets they could not afford outright. Those assets may grow, produce income, or unlock new opportunities. Meanwhile, the cost of waiting quietly rises. Inflation, changing prices, and shifting markets slowly erode the value of money that stays still. This creates a subtle pressure. Borrowing becomes not just an option, but a survival strategy. None of this happens loudly. There are no announcements, no warnings, just quiet incentives nudging behavior in a specific direction. Financial institutions are central to this design. Their business models depend on lending. When they lend, they earn. When borrowers succeed, institutions succeed alongside them. This creates alignment. Systems naturally support what benefits them. This is why borrowers with a history of repayment are often offered better terms over time. Access improves, trust grows. The system begins to treat them as insiders, not because they are morally superior, but because they are predictable participants in the machine. This dynamic extends beyond money. Businesses that leverage borrowed capital can expand faster than those relying solely on saved resources. They can hire earlier, invest sooner, and absorb short-term setbacks more easily. The system favors speed, scale, and momentum. Borrowing provides all three. Even governments operate this way. Public projects are rarely funded entirely by savings. Borrowing allows action now with repayment pushed into the future. The assumption is always the same: growth will cover the cost. This assumption is the foundation of the modern world. And this brings us to a deeper truth. The system does not reward borrowers because borrowing is virtuous. It rewards borrowers because borrowing aligns with its core belief that the future will be bigger than the present. Those who act as if they believe this are welcomed in. Those who hesitate are left waiting. This does not mean borrowing is always wise. Many people fall into traps by borrowing without purpose or understanding. High-interest debt, emotional spending, and pressure-driven decisions can cause real harm. The system rewards informed borrowing, not desperation. But here is where the conversation becomes uncomfortable. Because once you see that the system quietly favors those who lean into future growth, you also begin to notice how unforgiving it can be toward those who do not or cannot. People who rely strictly on cash, who move cautiously, who avoid leverage altogether, are often treated as lower priority. They are seen as safe, but invisible. No special terms, no accelerated access, no sense of urgency from institutions designed to move forward, not wait. Stability without momentum rarely attracts attention in a system obsessed with expansion. This creates a psychological divide that rarely gets discussed. Borrowers are trained to think in timelines and projections, while non-borrowers are trained to think in limits. One group is encouraged to ask, "What could this become?" while the other is quietly conditioned to ask, "What could go wrong?" Over time, this difference in framing compounds. Opportunities begin to feel natural to one group and risky to the other. The system reinforces this split by rewarding confidence backed by structure, even when that confidence is borrowed itself. What makes this more unsettling is how early this conditioning begins. Credit scores, financing options, and financial responsibility are introduced as neutral tools, but they shape behavior long before outcomes are visible. People learn that participation matters more than perfection. A small, manageable risk is often treated more favorably than no risk at all. The system reads engagement as belief, and belief, in this context, is currency. So the real question is not whether borrowing is good or bad. It is whether you understand the game being played around you. The system is built to accelerate those who move with its assumptions, not those who stand still waiting for certainty. Once you recognize that, you are no longer just reacting to incentives. You are deciding whether to use them consciously or remain subject to them without realizing why doors keep opening for others first. Education around this distinction is rare. Many people are taught to fear debt without being taught how to use it. This creates a population that avoids borrowing while quietly subsidizing those who use it well. Those who understand the rules move ahead, while others are told they are being responsible. This is not a moral failure, it is an information gap. Halfway through this story, it is worth pausing and asking a difficult question. If borrowing carries such advantages, why is the fear of debt so widespread? Part of the answer lies in control. Fear keeps people cautious. Cautious people are predictable. Predictable people are easy to manage. When borrowing is framed only as danger, many never learn how to make it work for them. Another part lies in visibility. Success built through borrowing often looks like talent or luck from the outside. The leverage behind it remains invisible. Failures, on the other hand, are loud. They become warnings, stories passed down to discourage risk. The system does not correct this imbalance because it benefits from it. There is also a psychological layer. Borrowing requires belief in oneself and in the future. It requires the courage to commit to a path before outcomes are guaranteed. Many people are discouraged from developing this mindset. Safety is praised, risk is criticized, yet the rewards quietly flow in the opposite direction. This contradiction creates tension. As time passes, those who borrow wisely gain not just financial leverage, but social leverage. They're seen as trustworthy, capable, established. Opportunities find them more easily, doors open sooner. This compounds in ways that are hard to reverse. Meanwhile, those who wait for certainty often find that certainty never arrives. The system rewards borrowers because borrowers move first. This does not mean everyone should borrow, it means everyone should understand why borrowers are rewarded. Knowledge restores choice. Without it, people operate on fear instead of strategy. There is a moment, often subtle, when people realize this. They notice that the rules they were taught do not match the outcomes they see. This realization can feel unsettling, it can feel like a betrayal, but it can also feel empowering. Because once you understand the incentives, you can decide how to engage. You can borrow with intention instead of avoidance. You can assess risk instead of running from it. You can choose tools instead of inheriting fears. The system will not explain itself. It never does. It responds only to behavior. Borrowers speak the language it understands. As this story approaches its end, consider this thought. Systems are not moral entities. They do not care about fairness. They care about function. Borrowing fuels function. Movement sustains structure. Growth justifies existence. Understanding this does not make someone greedy or reckless. It makes them aware. Awareness is the real advantage. If this perspective changed how you see money, progress, or opportunity, take a moment to show your support by liking this video. Subscribe to the channel for more deep, thoughtful explorations like this one. And most importantly, share your thoughts in the comments. Do you believe the system rewards borrowers, or do you think the risks outweigh the benefits? Your perspective matters, and the conversation starts there.